All right, let's talk about a part of your business you might be totally overlooking: accounts payable. Now, we're not just going to talk about paying bills today. Oh no. We are going to treat AP like a strategic weapon, a tool for truly optimizing your company's cash flow. Let's dive in. So, let me just start with this question. What if you could get an interest-free loan from every single one of your suppliers? I mean, think about that. It's not just some fantasy. It's the hidden power locked inside a well-managed accounts payable department. This isn't about just paying off debts. It's about taking command of your cash. And this really gets to the heart of it. Here's the big idea for today. Accounts payable is not just a debt you have to deal with. It is one of the most powerful, and I mean seriously overlooked, strategic tools you have for managing your company's financial health. And over the next few minutes, I'm going to show you exactly how to wield it. To do that, we've broken this down into 5 parts. First, we'll build the AP foundation. Then, we'll get into the mechanics of recording the transactions. After that, this is the fun part. We'll dive deep into measuring AP efficiency. Then we'll talk strategy. And finally, we'll look at AP's financial twin to see the whole picture. Okay, let's get started with section 1, the AP foundation. We've got to lay the groundwork here and make sure we're all on the same page about what accounts payable actually is. So the textbook definition says accounts payable, or AP, is a company's short-term obligation to pay for stuff it's already gotten on credit. On a balance sheet, it lives under current liabilities. And all that really means is it's a debt you've got to pay back pretty soon, usually within 30, 60, or maybe 90 days. But honestly, the easiest way to think about it is this. AP is just a pile of your company's IOUs. That's it. You got the goods, you use the service, but you haven't paid the cash just yet. So that unpaid bill, it's an IOU, and it sits right there in your AP ledger. And you see this everywhere in a business, right? We're talking about supplier invoices for raw materials, payments to contractors you've hired, all those software subscriptions you have, your utility bills, even the bills from your lawyers and accountants. It all falls under the AP umbrella. Okay, now this is where it starts to get really interesting. Look at these payment terms. Net 30 is pretty standard, right? Pay us in 30 days. But 210 net 30, now that gives you a strategic choice. Do you grab that 2% discount and pay within 10 days? Or do you hang on to your cash for an extra 20 days and put it to work somewhere else? This is the exact moment AP stops being a chore and starts being a strategic tool for managing cash. So we know what AP is. Let's move on to section 2 and look at the actual mechanics. How does this stuff get recorded in the books? It's a really clean 2-step dance, all thanks to double-entry bookkeeping. So, step 1, you get an invoice. Bam. Your accounts payable liability goes up, and something else, like an asset or an expense, goes up too. Step 2, you pay the bill. The liability gets wiped out, and your cash account goes down. The beauty is, the books are always in perfect balance. Let's walk through a quick example. Let's say your company buys $10,000 worth of office furniture on credit. When that invoice hits your desk, you debit your assets account for $10K and you credit accounts payable for $10K. That creates the liability. Then, when it's time to pay, you do the reverse. You debit accounts payable to make that IOU disappear, and you credit your cash account. See? Perfectly balanced. All right, now we shift gears. We've talked about the what and the how. Now let's get to the so what. Welcome to section 3, measuring AP efficiency. This is where we stop thinking like a bookkeeper and start thinking like an analyst. Because you know the saying, if you can't measure it, you can't manage it. And to do that, we're going to use 2 key financial ratios as our toolkit. These numbers tell a fascinating story. They reveal how a company thinks about its cash and how it treats its suppliers. We're talking about the AP turnover ratio and days payable outstanding. First up, the accounts payable turnover ratio. Basically, this tells you how many times a company pays off its entire AP balance in a year. Now, you might think a higher number is always better, and it often points to efficiency. But context is everything. A fast food chain is going to turn over its payables way faster than, say, a company that builds airplanes. So you have to compare apples to apples. So here's how you figure it out. You take your total net credit purchases for the year and you divide it by your average accounts payable. And that average is just the beginning balance plus the ending balance divided by 2. It smooths things out. It's a pretty simple calculation, but it's incredibly powerful. Let's put some numbers to it. Let's say a company had $130 million in credit purchases, and its average AP balance throughout the year was $20 million. You just divide 130 by 20, And what do you get? 6.5. So what does that mean? It means this company pays off its entire accounts payable balance about 6.5 times per year. This gives us a really solid baseline for how quickly it's settling its debts.
Now for a second metric, and this one, in my opinion, is even more strategic. It's called Days Payable Outstanding, or DPO. This number tells you, on average, exactly how many days it takes for your company to pay its suppliers. This metric is a dead giveaway of a company's cash management strategy. The formula for DPO looks like this. You take your average accounts payable, divide it by your cost of goods sold, and then multiply the whole thing by 365. Now, why COGS? Well, it's generally the best number we have that represents all the daily purchases a company is making on credit from its suppliers. Okay, let's run another example. Imagine a company has an average AP balance of $15 million, and its cost of goods sold for the year was $100 million. You plug those numbers into the formula, and you get 55 days, and that is the number that tells a story. On average, this company is using its suppliers' money as an interest-free loan for almost 2 full months. That's 55 days of extra cash they can use for operations, for investment, whatever they want. Now, this is a delicate dance, right? You push that DPO too high, and you start to seriously damage your relationships with your suppliers. It's a balancing act. Which leads us perfectly into our fourth section, strategic AP management. Now that we know how to measure our efficiency, how do we actually manage it? How do we turn AP into a real competitive advantage? Well, here are 5 T's to get you there. 1. Automate your invoice processing. Get rid of the errors and late fees. 2. Actively negotiate better payment terms. Don't just accept what you're given. 3. Reconcile your books constantly. Accuracy is paramount. 4. Keep your eye on the ball. You have to monitor those key metrics like DPO. And finally, number 5, and maybe the most important, none of this works if you don't have strong, trust-based relationships with your vendors. Okay, for our final section, we need to zoom out a little bit. Because to truly master accounts payable, you have to understand its counterpart, the other side of the financial coin. Check this out. Accounts payable, AP, is the money your company owes. It's a liability. The perfect mirror image of that is accounts receivable, or AR. That's the money that is owed to your company by its customers. It's an asset. And here's the key insight. Your AP is always your supplier's AR. Understanding that duality is everything when it comes to managing your company's entire cash flow cycle. And that really brings us to this perfect summary. Accounts payable is so much more than a stack of bills you have to pay. It's a critical piece of business accounting and, more importantly, of strategic financial management. When you manage it effectively, you improve cash flow, you build stronger vendor relationships, and you directly boost your company's financial health. So I'll just leave you with this one final question to think about. Is your business treating its accounts payable like a boring back-office chore, or are you treating it like the powerful, strategic financial tool that it really is? The answer to that question will have a direct impact on your bottom line.